If you've looked at the US housing market recently, you've probably asked the same question everyone's been asking. How on earth are home prices still rising when almost no one can afford to buy? Mortgage rates are near 20-year highs. Inflation has eaten into savings. First-time buyers are being pushed out of the market entirely. And yet, the numbers keep climbing. In many places, houses that sold for $300,000 just a few years ago now cost $500,000 or more. At first glance, it makes no sense. Higher interest rates usually mean lower prices. When loans become more expensive, fewer people buy, demand drops, and prices follow. But this time, the opposite happened. Prices stayed high, and in some cities, they even went up faster. So what's really driving this strange new reality? To understand it, we need to look deeper, not just at the market, but at how the entire American housing system has evolved. Because the truth is, what's happening right now isn't a random fluke. It's the result of more than a decade of buildup. Let's start with the most obvious factor: supply and demand. The US doesn't have enough homes. Not even close. After the 2008 housing crash, home building collapsed. Construction companies went bankrupt. Skilled workers left the industry. Banks stopped giving out loans for new projects. For years, builders were too scared to ramp up again. And during that time, America kept growing. Millions of new families, new immigrants, new workers, all needing a place to live. But the homes just weren't being built fast enough. Today, experts estimate the US is short by anywhere between 4 to 7 million homes. That's not a small shortage. It's a massive gap that keeps getting worse every year. So even when interest rates go up and demand falls, the limited number of houses means prices don't fall much. It's like musical chairs. Fewer players might be playing, but there still aren't enough chairs to go around, and that's only the beginning. Over the last decade, the type of buyer in the housing market has changed. It used to be mostly families buying a home to live in. Now, more and more buyers are investors, corporations, hedge funds, and private equity firms who buy homes in bulk. These investors aren't thinking about monthly mortgage payments. They're thinking about returns. They see homes as assets that generate income through rent and long-term appreciation. In 2021 alone, investor purchases made up nearly 1 in every 5 home sales in some parts of the US. And the trend hasn't stopped. Even when mortgage rates rose, large investors had cash. They didn't need loans. So while normal buyers dropped out, these big players kept buying, especially in affordable regions like Texas, Georgia, and Arizona. That competition pushes prices up, not just for the houses being sold, but for the ones around them too. Meanwhile, there's another group affecting the market: existing homeowners. Millions of Americans locked in ultra-low mortgage rates during the pandemic, some as low as 2.5 or 3%. Now, with rates more than double that, these homeowners are staying put. Why would you sell your house with a 3% mortgage just to buy another with a 7% loan? You wouldn't. That means fewer homes are going on the market, and fewer homes means higher prices for the ones that do. It's what economists call the lock-in effect. So the market is frozen. Sellers don't want to sell. Buyers can't afford to buy. And somehow, prices refuse to drop. But there's more. The cost of building new homes has exploded. Everything: lumber, steel, concrete, labor has gotten more expensive. And beyond that, there's red tape. Local zoning laws, permit delays, and environmental regulations make new construction painfully slow and costly. In some U.S. cities, it can take years just to get approval to build. Developers often decide it's not worth the trouble, unless they build luxury homes where profit margins are higher. So instead of solving the shortage, we're adding expensive homes that most people can't afford. That's one reason why the U.S. housing market has become so divided. In many cities, the wealthy keep buying, investors keep collecting rent, and everyone else gets left behind. But beyond economics, there's something more powerful: belief. For generations, Americans have been taught that real estate is the safest investment, that owning a home is the cornerstone of success, stability, and wealth. Parents tell their kids, "Don't rent, buy." Financial advisors say, "You'll never lose with real estate." That cultural belief keeps demand alive, even when logic says otherwise. People stretch their budgets, borrow from family, or move to smaller towns just to get into the market, because they believe prices will rise again eventually. And that belief often makes it true. But there's a growing consequence. In cities like Los Angeles, San Francisco, and Miami, first-time buyers are being locked out completely. Incomes haven't kept up with home prices, and now even renting has become a struggle. A generation that once dreamed of homeownership now feels it slipping away. This is changing the social fabric of the country. Owning a home has long been the foundation of middle-class wealth in America. When that foundation cracks, inequality grows wider. Wealth concentrates among those who already own property, while younger and lower-income families fall further behind. It's creating what some economists call a two-tier housing system: owners on one side, renters on the other, and fewer ways to move between them. Now, is this a bubble? Some people think so. They argue that the market has become disconnected from fundamentals, that prices are being held up by speculation and artificial scarcity. But others believe it's not a bubble at all. It's the new normal, a world where land, materials, and regulation make cheap housing nearly impossible to build. Even if prices dip in some regions, the overall shortage means they're unlikely to crash like 2008. Instead, we might see years of slow adjustment, where affordability continues to erode, but the market never fully corrects. And this raises a difficult question. If the American dream has always been tied to homeownership, what happens when that dream becomes unreachable for most people? Some cities are trying to respond, experimenting with relaxed zoning laws, rent control, and incentives for affordable housing. Others are exploring modular and 3D printed homes to lower costs. But these solutions are slow, local, and uneven. The reality is, fixing the housing crisis will take time, and a complete rethink of how we build and live. Until that happens, prices will likely stay high. The market may cool slightly, but affordability will remain the real crisis. Because this isn't just about numbers, it's about people. Families delaying having kids because they can't find a home. Young adults working 2 jobs just to afford rent. Communities changing as locals move away and investors move in. The U.S. housing market isn't broken because of one bad decision. It's the result of decades of choices, incentives, and beliefs. And unless those change, the story of rising home prices isn't ending anytime soon. So what do you think? Will the housing market ever cool down? Or is this just the new normal in America? Let me know your thoughts in the comments below. I'd love to hear what's happening in your area. If you found this video helpful, don't forget to like, subscribe, and comment below. And share it with someone who's been talking about buying a home. It really helps the channel grow and reach more people who care about these topics. Thanks for watching, and I'll see you in the next one.